December 1999. Barron's magazine runs a cover story mocking Warren Buffett. The headline, "What's wrong, Warren?" Berkshire Hathaway is down 19% for the year. Nasdaq's up 85%. Buffett won't buy tech stocks. Old man's lost touch. Doesn't seem to understand it. Financial media says he's finished, he's washed up, a dinosaur, a relic. 24 months later, Berkshire's up 29%. The Nasdaq is down 78%. Now, I want you to hold on to that image in your head for the next 10 minutes because I'm going to show you something that looks almost identical to the December 1999 setup. The same euphoria, the same mocking of caution, the same rotation away from quality into momentum. Except this time, the setup is worse. Because in 1999, there was one dominant risk in the market. Right now, there are 4 major ones brewing, and they're all present simultaneously. For the first time in 50 years, too, by the way. So the trap is set. Question is everyone going to walk into it? And are the people screaming doom actually right? That's what we're going to investigate in the second part of the video. So let me walk you through the 4 historic risks that have each on their own caused major market crashes since 1972. The S&P 500 has had 4 catastrophic drawdowns in the last 50 years. 1973 had the inflation shock, down 43%. 1987, liquidity crisis, down 30%. 2000, the tech bubble, down 47%. 2008, you had the credit collapse, all that kind of stuff, went down 55%. NASDAQ, of course, goes down more because it's more volatile. Every single one was driven by one dominant risk factor. One. That's what made each of them survivable. If you saw the right risk, you could position accordingly. Right now, shit's crazy out there, man. So of course, the first risk, the inflation problem. We have a commodity supercycle, which is quietly forming in the background. You have energy, you have metals, you have agriculture, all breaking out on a multi-year basis. The Iran situation is just adding more fuel to the fire as global energy markets are facing their biggest crisis basically ever. The Fed's preferred inflation gauge has been above 2% for 18 of the last 24 months. The narrative right now is saying that inflation was tamed, but the data is saying otherwise, and the new Fed chair is going to have a hard time trying to convince everybody that anything's actually different than that. Now, the second big risk, of course, is the liquidity situation. So we are right now experiencing the largest equity supply shock since 2000. SpaceX, OpenAI, Anthropic, Anduril, Databricks, all these big IPOs are coming. We know SpaceX is coming in about 2 weeks. Anthropic is filed for an IPO, so they're coming relatively soon. Combined, just the top 3, SpaceX, OpenAI, and Anthropic, are worth around $5 trillion. Where does the money come from? Where's that money come from? Google's also flipped from $60 billion a year in buybacks to $80 billion a year in net issuance in order to chase more capex. Trillions of dollars of IPOs and lockup supply will be hitting the markets in 2026. That's an enormous amount of money that needs to be absorbed by a market already kind of running on fumes from retail FOMOs. Everybody's all in all the time. The next risk, of course, is the concentration of the market in a very, very specific sector. Semiconductors are currently trading 73% above their 200-day moving average. That's the largest stretch since March 2000. Now, if you know your market history, that sentence should make you uncomfortable. Micron, Palantir, all of it. They're all showing the potential for climax coming soon. This is what a blow-off top kind of looks like in real time. I mean, look at the charts on all the major stocks. They've gone absolutely insane. It's a very risky time to be buying stocks if you just look at the charts. I mean, SanDisk has a monthly RSI of 99. Who the fuck is buying that? But people are, and it keeps going up in price for some reason. Then we have the credit markets. Now, this is something we've talked about multiple times before here on the channel, but it hasn't gone away. The credit market is still in a dangerous zone. So the big guys like Blue Owl and Blackstone, they all have gated redemptions on their evergreen private credit funds within the last few months. When the biggest names in private credit start freezing withdrawals simultaneously, I mean, something is breaking beneath the surface that the headlines haven't caught up yet to, or simply don't want to admit. So we have all these risks building up in the background while stocks just keep on ripping regardless of Iran or credit market risks or any of that kind of stuff. It's the perfect environment, of course, to release these mega IPOs because everyone's ready to be exit liquidity again. But here's the part of the setup that almost nobody's talking about, and it's actually the most actionable piece of the whole picture. While AI stocks have gone vertical, one specific category of stocks has been quietly left for dead. And historically, that's exactly when generational positions are built. That's coming up. Well, the AI complex is melting up. Something strange has been happening to the boring, durable, cash-generating businesses that have survived every crash in modern history. Berkshire Hathaway's, the trailing S&P 500 by hundreds of basis points. You have super boring companies, Coca-Cola, Procter & Gamble, this kind of shit, right? Trading at multi-year relative lows. Healthcare versus the S&P 500, 25-year relative low. 25 years. Holy shit. What's interesting, what's concerning, what you should at least be aware of, this is the same pattern that played out in 1999, almost point for point. The businesses with real earnings, real cash flow, and real balance sheets right now are insanely boring. And they are being treated as basically dead money. Why would you put your money in some of these things when you could do something much more exciting? And I get it. When growth is growing, that's where your money should be. When growth stops growing, you should rotate back into safer plays. Capital is flooding into anything with AI in the pitch deck right now. And I don't think that the fever is over, personally. I think we still have a long way to go, even if for short term we might do for a bigger correction after some of the excesses we've seen recently. Valuations kind of don't matter anymore. The market caps don't matter. Profitability doesn't matter. And a lot of the big hyperscalers are not really profitable, but the companies selling them the chips and the memory cards are very profitable. And that's the interesting thing here, is that the earnings and profitability for a lot of the companies in the AI sector have been unbelievably big and keep up with the valuations. But we're at a growth at any price situation, and smart money is sitting in quality stocks and they're being mocked for missing the party. People like Warren Buffett. It's a different game, let's say, what Warren plays. Whereas some of the big hedge funds, the tech investor funds, have made hilarious money. Ray Dalio went on Bloomberg recently and said something worth repeating slowly. He compared the current market to two specific years, 2000 and 1999. That in of itself, Ray Dalio saying the current market reminds him of 2000 and 1999 should be enough to make you stop and go, maybe there's something worth listening to here. And I'm paraphrasing, but he said, all great technology revolutions produce bubbles because nobody can get the pricing exactly right. And that bubble pops when there's a need for wealth to be sold to generate cash. He also said the technology is real. The prices and the debt are the problem. That distinction matters enormously. Nobody's saying AI isn't real. Of course, AI is awesome. Nobody's saying that hyperscalers aren't building something transformative, because of course they are. This is all very true. Just like it was true that the internet back in the 1990s would be a big thing, that it was valuable to invest in. But people get over their skis. Euphoria gets too crazy. Human greed takes over, and people ape into SanDisk at a monthly RSI of 99. I just gotta keep talking about monthly SanDisk of RSI 99 because it's so crazy, man. Goldman Sachs just revised their combined CapEx estimate for Google, Meta, Microsoft, and Amazon up to $5.3 trillion through 2030. Now this matters because everything that you're hearing, the CapEx just keeps going. The hyperscalers just keep spending mind-boggling sums of money. $5.3 trillion in CapEx spending over the next 3 years. That's halfway to 2027. The infrastructure build-out is generational and genuine, and it's going to require massive amounts of energy and copper and data centers and more semiconductors and more memory and all that kind of stuff. But there is a canyon of difference between a real technology and a correctly priced stock. In 2000, the internet was also real. While the market figures out what it's worth, your cash, of course, can either be working or it isn't. That's why I want to talk about Xapo Bank real quick. Xapo is the world's only Bitcoin native private bank. And right now they're offering 3.35% interest on US dollars paid out daily to your account in Bitcoin, which is the ultimate way to dollar cost average while you're just sitting on cash directly into your account. No lockups, no minimums to earn. And because it's built on Bitcoin infrastructure with a Bitcoin first ideology built by a Bitcoin OG, you can move in and out of Bitcoin instantly directly in the app without leaving the bank. And they also have stocks. You can get stocks too. You can get gold ETFs, all that kind of stuff. So everybody's out here debating whether the market's going to go up or the market's going to go down. Xapo members are earning yield either way. So if you're sitting in cash, you can be earning Bitcoin. Plus, you can earn Bitcoin on your Bitcoin. Plus, their debit card pays you back 1% in Bitcoin on every swipe of the card. That's awesome. So in a market full of uncertainty, if you have idle cash, put it to work. Get it earning some Bitcoin for you. Great time to dollar cost average in. Open up your Xapo account through the link down below. We both get $500. That's right, you'll get $500 for signing up for Xapo account. Your money should be working harder than it is right now. Link down below. Go check it out. Now let's talk about what's actually coming over the next few weeks, because the timing here is very specific and it matters. June 15th is a date we're circling. Several converging catalysts land right around that window simultaneously. The SpaceX IPO alone represents one of the largest single liquidity drains in market history. Major IPOs pull capital out of existing positions. The 1990 to 2000 dot-com IPO wave extracted over $100 billion from the markets before the NASDAQ crashed 78%. Most of those companies did not do well. The SpaceX raise is targeting $80 billion at a $2 trillion valuation, which is absurd based on the numbers. Go watch my SpaceX video if you want more information on that. That money has to come from somewhere. Then on June 17th, the Fed meeting happens. Kevin Warsh, this will be his first meeting. He's running potentially a more hawkish Fed. The markets are priced in, although there's some surprises that he could bring out. So make sure to watch my Fed video, by the way. There's some surprises they might bring out that actually may end up making Kevin Warsh a much more dovish Fed. But regardless, the market's very uncertain about it. And that uncertainty is where the canyon of despair lies, because people don't know what's going to happen. And they will be positioning in the lead up to that in a way that makes them safe, let's say. When the Fed surprised, of course, the 75 basis point hike back in June 22, the S&P 500 dropped 8.4% in 5 trading days. A hawkish surprise from Kevin Warsh, even a tone shift, even a fucking tone shift, because that's what color tie did he wear? That could be the pin that meets the balloon. Add to that things like Micron and Oracle are having their earnings landing right around the same time, and of course they better be damn good. Semiconductor and enterprise software earnings have historically marked cycle peaks, and I don't think we're there yet personally. I think we're still a long way from a cycle peak, but this is what you have to understand. You have to be aware of these things right now. Micron peaked in June 2018. The S&P 500 followed with a 20% correction by December, and underneath all of it, short interest on the S&P 500 just jumped to 3%. 1.4 billion new shares sold short while retail is buying the breakout. 64% of stocks in the index are seeing growing short positions in just the last 3 months, the highest level since right before the 2008 crash. Consumer sentiment tells the same story from another direction. 55% of Americans now expect higher stock prices over the next 12 months, the third highest monthly reading since 1978. It's almost my entire life. I was born in 85. Higher than the peak of the dot-com bubble. Higher than 2018. Nearly double the 49-year average of 36%. Almost everyone expects stocks to go up. History has a very consistent and unfortunate answer. Crowd's usually wrong. This is critical. I'm going to give you the full counter argument, because that's what the doom bears are saying right now. They've got some fucking good points. We cannot argue that. But the bull case is also not stupid. And here's the thing you need to understand. Markets can remain irrationally bullish longer than you can stay fucking sane. So if you sell everything and hide in cash, you might miss what Tom Lee is calling one of the best 18 to 24 month periods of our investing lives. The tension is real. Sell now before it crashes, or holy shit, we got 24 months to ride. Let's keep rolling the dice. You need to hear both sides. Every bull market climbs a wall of worry. That's not a cliche. It's a structural truth about how markets work. Tom Lee, of course, one of the most accurate market forecasters over the last several years, minus his $10 billion loss on Ethereum. Tom, you better pump my Bitmine bags, dog. He is calling for one of the best 18 to 24 month stretches that investors have ever seen. Those are big words. Now look, Tom's not being reckless here. He has a framework and he has a track record. You can say that his framework's wrong. You can discuss his track record, but he's making a call. Consider this. No, really. Listen to this. From the bear market lows of October 2022, the NASDAQ is up 162%. Let's go, baby. During the actual dot-com melt-up from 1995 to 2000, the NASDAQ went up 572 fucking percent. 572%! By that measure, we haven't even reached the halfway point of what a true bubble really looks like. Plus, again, and I just need to keep beating the dead horse here, earnings are keeping up with valuations. Yeah, the market might be getting a bit over its ski on some stocks, but money will rotate out of those, rotate into other AI plays. And the CapEx numbers are staggering and real. Goldman estimates, again, $7.6 trillion in hyperscale infrastructure spending by 2031, or $5.3 by 2030, whichever way you want to slice the cat here. That money doesn't evaporate. It becomes data centers, chips, cables, power plants, cooling systems, software, jobs, revenue, compounds, and historically, of course, midterm election years, which is 2026, follow a very specific pattern. A correction in the first half, a powerful recovery in Q4. That playbook would suggest any drawdown that comes in June or July due to the SpaceX IPO and the Fed meeting, right, that kind of stuff, is actually going to be a huge buying opportunity, not a structural top that's going to lead the market down 78% or whatever. The short interest spike could also be read as fuel for the next leg up. These kind of market situations are very difficult because they're so rare and everyone's unique in its own way. We draw dot-com parallels because that's the last time something like this happened. But it's not a perfect parallel because the dot-com bubble, all these companies came out, had fuck all earnings but insane valuations. It's different this time, but it's never different. The market will still get over its skis. People will still become too euphoric. People will still ape in the top and all kinds of shit. But the problem is, are we at the top yet? Maybe for some stocks, yes, or they'll need massive corrections, but other stocks, no. And the AI trade itself doesn't seem to be slowing down. Certain players may have big adjustments. Others will keep running. A heavily shorted market, of course, that keeps grinding higher creates a short squeeze dynamic. The bears become forced buyers. That's what happened repeatedly in 2023 and 2024. The bear crowd is not wrong, okay? They're not wrong. A lot of the stuff they're saying is exactly right. The problem is they might just be a few years too early. As we climb the wall of worry and everybody keeps freaking the fuck out, the NASDAQ could run another 200% or something like that, which sounds insane, but that's exactly what happened in the 90s. So where does that leave us? Lots of historic risks, sentiment at near record highs, liquidity shock from IPOs, Fed meeting, what the hell is going to happen? Private credit, yeah. On the other side, real technology, real capex, real earnings, and a historically low NASDAQ relative to true bubble valuations. That's the thing to keep in mind. And of course, a political cycle that historically resolves higher by year end. There's still a lot to like about the market more broadly. Well, maybe not the crypto market, but certainly the stock market. It's probably due for a decent correction at some point. Honestly, it's had way too much of a crazy run so far this year. It needs a cool-off period, and cool-off periods are cool and normal and allow you to reset and reinvest in some of your popular names. But here's the thing. This is not a simple market. It never is. Anyone telling you it is in either direction going to go down definitely or up definitely. Most of them are full of crap. Right? Opinions are like butts because everybody's got one and some of them stink. My stinky butt opinion here, the risk reward for broad market exposure has rarely been worse. But the risk reward for quality stocks, Berkshire's, the defensive compounders, the business that were born in 1990, rarely been better. That being said, those may not become great buys just yet, because there's still an insane amount of opportunities in all these growth stocks. So instead of chasing the big names of today, try to look for the big names of tomorrow. And a lot of those names have been talked about. We've talked about some of those on the channel. For example, will Jensen Huang be right and Marvel's the next trillion-dollar company? If so, there's a shit ton more upside there than buying Berkshire today, right? These things will have their day in the sun, but only when shit hits the fan. And I think, while the shit may have been thrown towards the fan, it's moving in very slow motion and hasn't hit the fan yet. The AI trade is real. It's also starting to be priced for perfection in some areas, but nothing's perfect. But then the earnings are insane, and the demand for memory is booked out for a year. It's very interesting because the trap in some ways is set, but it's going to close very slowly. And by the time you realize the trap has closed, it'll be too late. So remember to invest wisely. Don't be silly, guys. Markets are showing some risks here. Understand what they are. Thanks for watching.